Good afternoon, everyone. Welcome back to Markets for Millennials for our weekly market update from April 4th through today, April 8th. And we're starting off with the DXY. Now, the big news of this week was the Fed meeting minutes, and became abundantly clear that at the March FOMC meeting, they were talking about that the consensus going forward is that they do see 50 basis point hikes coming, and they talked about balance sheet roll-off to a maximum of something like, I think, 95 billion from the balance sheet every month. And so this was, I wouldn't call it necessarily a hawkish surprise, but the Fed obviously has turned particularly to the inflation narrative. Most people have been in denial, and I guess I'm starting off this video today kind of with the narrative, because I think the market is expecting, because of what happened in the financial crisis in 2008, and because of all the times that the Fed has tried to rein in liquidity and do tightening and things like that, they've always had to pivot. And so I feel like it feels a lot like, and just the general consensus around the market is that the Fed is going to have to pivot, and so they're pricing in policy mistakes and having to make that pivot. And there's a lot of discussion of that being why that being why equities got their little bounce, why crypto got its bounce. And a lot of people don't realize that the big difference between now and the rest of the last 14 years or so is that now we have a really big inflation problem that is being exacerbated by the supply chain issues regarding that came as a result of COVID, and because of the geopolitical situation with Russia and the sanctions and the Russian response. And that is a convergence of things that did not happen over the last 14 years, all at the same time. In fact, over the last 14 years, up until the COVID crisis, it was deflation that was the dominant trade. That's why tech was going crazy. That's why growth was going crazy over the last 12 years before the COVID crash. So, having said all that, like I said, I don't think it's a hawkish surprise so much as the realization that the Fed is actually not concerned about the market tanking, at least not that much. As long as it doesn't spiral for now into or cascade into a lot of different things. Like, I think they are willing to let the markets tank, maybe even 20 or 30%, or maybe more, because right now they are incentivized to fight inflation above all else. And so I think that's something just from the start that everybody needs to understand. We're not looking at a Fed that is incentivized to save the market. We're looking at a Fed that is incentivized to stop inflation at all costs. And it's not to say that even what they're going to do will stop inflation, but they are going to try to do it, and they're going to do it by pulling liquidity and raising rates. And we'll see what happens. So we're starting off looking at the DXY. You'll see this gold line, that's a dotted line that's crossing the page. Earlier this week, I put in an alert for that. That's the 100 line. I on Twitter, I posted that I thought we would see DXY at 100 yesterday, but then I revised that and I said I thought we would see it today, and sure enough, we did poke above 100, and we closed below it, but we did poke above it. And I feel like out of many people, I mean, just across Twitter, everybody has been looking at the DXY, and there are people putting Wyckoff patterns over the DXY. There are people talking about, oh, this is a double top. And I think when they say double top, I think if I pull the chart back, I don't see a double top. I see, slightly lower lows every once in a while over the last 5 years. But for some reason, people have been looking at this and saying topping pattern And if you follow me on Twitter, then you know that I've been saying, no, this is not a topping pattern. This is a channel, basically a flag that is consolidating after this run up that kind of started in early February. And you've seen that what I did was, if I just what I'll do is I'll darken this line up. So if you've been watching my channel, you know I was following the solid line, and then we broke out of it, and then we started consolidating, and we got two wicks on that line, so I kept it. And then when we came back up and got rejected, I basically drew this line across after having realized that, and I still don't understand why it keeps misaligning. I don't know if I did it wrong the first time. I don't really know. But anyway, I had this line originally because it was lined up to previous peak highs over the last 5 years. And I realized, hey, wait a minute, this looks like the top of a range, of a new consolidation range. And then I kind of watched as we came down, and if you were following me on Twitter, then you saw that what I was looking for was for a price to hold right there. And as soon as we didn't hold that spot, and we actually came below it, then let's go down to an 8 hour so I can show you. We popped down below and closed below, and then I watched the next 8 hour candle, and I thought, okay, so maybe that line is relevant, and this is a breakdown, and we're going to retest and resume down. But then as soon as we failed to make a lower low on this next candle that you can see where my mouse is, once we did not make a lower low, we didn't even close on this 8 hour candle below the March 30th overnight candle. We didn't make a lower wick, we didn't make a lower closing low, and as soon as I saw that, I started thinking, okay, well, what's the market showing me? And I took this line and I cloned it and I put it right here. And it turns out that it provides resistance right over here on the 2nd and 3rd of March, and then with support all the way across. And so as soon as that happened, I pivoted to, this is like a bull flag basically, and I probably could even get rid of this line right now, but I saw this as a bull flag kind of a channel situation. While everybody else was saying topping pattern and we're going back down, I said, no, we're consolidating and then probably going to go up. And my prediction was, and I've been putting this in my newsletter as well, my prediction was that we were going to go at least into the hundreds, the low hundreds. And so my target is reached as far as like getting to 100. And so, oops, I didn't mean to do that. My target was reached, and so for that reason, I jokingly posted earlier saying I'm okay with the dollar now going back down and breaking our support and all that. The way that things are going, I could see the dollar going up even further. It doesn't look like there's any halt in the momentum at this point. We did get the fact that we did get this wick. I think this wick is not because there's necessarily strong resistance there, but more because psychologically that 100 number is a big deal. So actually what I'm thinking might happen is we'll come back down and try to test this level as this kind of the above the upper level of that channel as support, and then we'll resume off. So I think it'll probably maybe over the next couple of days into next week hit that, and then we'll go back above 100. I could totally see that happening. I'm not saying it will, but I could totally see that happening. Otherwise, if we came back down into the channel, then that's a little quick prairie dog fake breakout. And when that happens, or if that happens, then I think that will be the time to roll over and start looking for the dollar to break to the downside. But the thing that's affecting the DXY is actually the euro, which you're seeing here. So a lot of the dollar strength is because the euro has been losing strength, specifically against the dollar. But what's really interesting here, the euro is almost unchanged on the week against the yen, and almost unchanged on the week against the Australian dollar. But it is down fairly considerably over the week against the British pound and especially against the US dollar. And the euro makes up something close to like 53 or 55% of the DXY. And then the other thing, and I've been looking at this a lot, is the Japanese yen. And the yen, after looking like it was going to get destroyed this week versus all of the other currencies, it actually was able to gain a little bit against the Australian dollar and New Zealand dollar. It's almost break even against the euro, as I said earlier. But the British pound really beat the Japanese yen this week, and the US dollar beat the Japanese yen. And so that's why you see the DXY getting bid over the last few days, because the US dollar was strengthening against the euro and the Japanese yen. And that because those two combined make up like 70% or more of the DXY, that's why you see the dollar taking off. But then what's really interesting, I think, let's see, US dollar, Mexican peso, during that same time, other than, kind of earlier this week on Tuesday and Wednesday, you've been seeing the dollar lose against the peso. I think that's kind of interesting. And then you have the USD Russian ruble. Let's see if this, I don't know if I even have this right here. Let's go here. You have the US dollar getting destroyed against the ruble even, which I think is interesting. The ruble versus the US dollar is now at the levels it was even before. It's below the level that it was before Putin invaded, or before the Russians invaded Ukraine. So that's definitely a big deal. So spent a lot of time on the dollar because I think the dollar going up has been a really important thing going on. The 10-year Treasury, actually, I'm going to have to adjust this really quick. I don't know why this always happens. This line, this blue trend line, is a multi-decade channel going back to the 80s. And we kind of tapped the top, bounced down, and then have now broken through it. We're at a level of interest, or of 10-year yields, that we haven't seen for probably, I think, 3 or 4 years? I can't really remember. But it's been a few years since we've seen that level. It looks like this momentum trend line is holding. If we go to the US 2-year, that's also getting destroyed. Like the bond is selling off, and so you have the yield going up. What I saw, which was kind of interesting, and I'm actually going to, let me see here, 30-year yield minus the US 10-year yield. Oh yeah, interesting. So I saw somebody post that even the curve between the 30-year and the 10-year was almost negative, and so you can actually see here it's very close to break even, and so the bond market is telling you that things are going nuts, and so I think that that's also something to pay attention to. Now, let's look at what's been going on in the equity markets. And I've been posting about this. I talked about it in my newsletter. Still super important. Let me turn my moving averages on so you guys can see. It's going to be a little bit messy, but I've been making a big deal about these Fibonacci retracement levels and where the moving averages are. Today we're closing below our 200-day moving average, but the 50-day moving average is now curled upwards. So in the short term, that's good. We want to make sure we hold that 50-day moving average. And I want to see us get back above the other two, the 50 and the 100 and the 200-day moving average. I want to see us stay above there for at least a week. The NASDAQ, it's kind of an interesting situation. Actually, let me turn that on really quick. So let's see, the moving average, the 50-day moving average is at 14,338.48. And it looks like we are below that. So we've closed below that. So the NASDAQ, you'll notice here, this confluence, it's amazing how the markets work. We've got this 618 retrace, where it was rejected, which happened to be a confluence of also the 100 and 200-day moving average. And you can see right here as I zoom in, look at that, where the 100-day moving average crosses the 200-day moving average. You had basically perfect resistance there that rejected also at the 618 level, and now we're closing below. So that's actually a really bearish sign. Definitely not good going forward. On the Dow, again, on the Dow, it's actually better. We're actually holding our 50-day moving average. You do see we get that rejection at the cross right there of those moving averages, the longer moving averages. So the Dow looks better, but still precarious. I like to see all of the indices confirming each other. And then the Russell, which is, it is not good for the Russell. And actually what I'm going to be watching is I want to watch the zero the bottom of this move. I want to see when we revisit, if we revisit the lows, if this holds, because I suspect, and I've talked about this a lot on the Russell. If you remember, we had the consolidation sideways for basically almost all of 2021, where the Russell underperformed as the other indices were going up. The Russell was the first to sell off, but then you notice we didn't make a lower closing low. The last time we made our lowest closing low recently was in the end of January, where if you go back to the Dow, it was into March, NASDAQ into March, almost the middle of March, S&P into the middle of March. So the Russell was sideways consolidating. So it's weird to say this as price was coming down, but it actually outperformed the other indices. And another way to look at it would be QQQ over IWM. If we do this, then you actually see for that whole period of time, right? So that period where the Russell bottomed kind of in late January, and then into where the NASDAQ and the S&P and the Dow bottomed in the middle of March, the Russell was outperforming, and that's in this area. So I think that's interesting. So having said that, on the Russell, I'm going to be watching this level. If the Russell comes down further and closes below that level and makes a new lower low, then I think we are going to be in for a lot more pain in the near term. Let's take a look at gold briefly. Let me turn off my moving averages. On gold, look at that. The magical lines, once again, being magical. If you go to the 8-hour chart, you can see it's just perfect. We're squeezed in this range. We might even add another level, maybe somewhere around where we're closing at right now. But gold is stuck in this range, and I suspect that we could either stay in this range or we'll actually come off a little bit more, because I think we still need to give back some of the gains from this rise from the war premium. But honestly, I would feel most comfortable if we stay above 1916. I think that's probably the most important support level that we're currently at. Below 1916, and we're bearish again, at least near term. If we can get above 1967, that's very, very bullish. Take a look at oil. And I've been posting about this a lot and making a big deal about our Fibonacci levels once again. I also had a trend line. Let me go to an 8-hour. It's a little bit better. I had this trend line. You could actually extend this trend line back like that. It's not perfect, but it looks something like that. And it works. It was base support for quite a while, provided support on our drop after the initial move up, where we retraced almost the entire thing. And we again got rejected at the 618. Actually, if I turn my moving averages on, what happens? Oh, nothing. Okay. Just wanted to check. And we are making lower lows and lower highs. And then we actually got below, you can see on my 8-hour chart, we got below that trend line, and we've retested it and started to come off again and made lower lows. And then we just came back up and we failed to get above it. And so I think, just like with gold, I think unless we have a major shift in what's happening in Ukraine and with Ukraine and Russia, then what I suspect is going to happen is we're going to consolidate like this, and we're going to need some time for this to work itself off before I still think the oil. I still think oil is bullish, so I think that after we get that consolidation for a little bit, oil will start to climb back up again. Now, again, it's tied to what happens in the Russia-Ukraine situation. If we get a peace deal soon, then I think we're going to see more to the downside as the war premium comes off, and I think that the market will sell that off at first, just like gold. I think they'll sell it off at first, because they'll be thinking, oh, everything is fine, everything's over, and there's no more need for this premium. Like, the supply is going to be guaranteed, we're going to cooperate. But in the long term, because of inflation and what the Russia situation and what COVID has done to supply chains and things like that, I just think the backdrop for oil is still so bullish. So take a quick look at Bitcoin. Bitcoin, it looked like we were breaking out. There were all sorts of different things I was watching to show that Bitcoin was actually, in fact, on the way up. Unfortunately, we've taken a pretty bad turn. I mean, look at this. I mean, how can we complain? We still haven't made a lower low than January 22nd. So actually, it's really interesting to note that the last time Bitcoin made a low closing low, a swing closing low, like the lowest one, is around the same time the Russell made its last closing low. So I think that's interesting. But things don't look good for Bitcoin in the near term. Obviously long term Bitcoin bullish, but definitely we're going to need some news or something to kind of give us a catalyst. I don't have the tweet up right now, but there's a lot out there in the Bitcoin community about I forget what the metric is called, but it's basically where the Bitcoin that is held in custody has not moved, like the highest percentage has not moved in over a year, like made new all-time highs. I sound very ignorant right now because I can't remember it off the top of my head. But anyway, that is obviously like bullish fundamentally, but obviously, the markets can stay irrational for longer than you can stay solvent. And so it's important to remember that even if on-chain metrics are showing bullish fundamentals, that does not have any bearing on near-term price action. Because, I mean, think about it. For how long have we been talking about the fundamentals being bullish? Like, the fundamentals on-chain have been bullish for this entire time. And yet we still had price come off again 50%. And we still are not seeing price even remotely close to its previous all-time high. So just be aware of that. Be careful. Make sure that you protect yourself. The Bitcoin conference happened, and there was some really great news. But actually, if you go onto the chart to the last Bitcoin conference, which I believe here we go. The last Bitcoin conference was in June, early June, I believe, something like right there, I think. So we actually sold off in the days following the Bitcoin conference. And I'm pretty sure that we traditionally sell off for a couple of days after the Bitcoin conference. So shouldn't be all that surprising. I think the one thing that I'm watching for is this pullback is difficult, but so is this one. So after we made the low in July 2021 and we came up, we had like 10 or 11 days in a row green. And then we came off and people were saying, oh, it's a dead cat bounce. We came down over 11% from that bounce. And people were saying, oh, we're heading back down to 20,000 or 10,000 or whatever. So this to me feels very similar, just in terms of sentiment. If we go from the wick to the peak, we're at about the same retrace. And if you go just from the close, it's a little bit less. It's under 10%. So I think that that's something to think about, and I'm trying to check my own emotions on that as well. Bitcoin is definitely not easy, and anybody who says it's easy, they are ignorant. They don't know anything. Anyway, trade safely. I hope you guys have a great weekend, and that's it for today, and I'll see you next time.